SK makes future green, and they are providing these classes free of cost for all the aspirants to clear the JIIB exam. So I'm glad to be a part of this initiative, and I hope that you all are liking it. So what we are going to do, we're going to start with the theoretical part. Yes. So we are going to start with the theoretical part, and later on we'll also cover some MCQs from this area. So if everything is working fine in class, okay. All right. So we have Akula ji and Krishna ji and Vicky ji here and Prajakta ji and one more user is here. All right. So let me just share the screen in a moment. Just a minute. Mm, okay. Vicky, shall we start?
Yes, madam, you can start.
Okay, okay. All right. Just a moment. Mm, oh no, I'm sharing the screen. Just one moment, please.
I started.
Just one more minute. Just one more. Able to do it. Okay. Just a minute. Yes. Uh, PPT. It's PPT. Here. Okay. So can anyone confirm? Is it visible now? All right, let's start. So this is the first module that we are covering of accounting and financial management for bankers. Now, in that, the first module is accounting principles and processes. It is mostly theoretical and it is actually completely theoretical, and we just need to focus on understanding the core concepts, and also some of the things are here which you need to mug up. Accounting standards, we can understand it, but the questions that are asked, they are in the way that what does accounting standard 4 deal with. So for that we need to mug it up as well. So I have given some tips how you can remember that. So I hope it will be useful for all of you. Now, first of all, let us understand what is accounting. That is the main concept of the subject. So, when I talk about accounting, let me just turn off the camera so you don't get distracted here. Okay. All right. So all cameras are off now. Okay. So if in simple terms we understand about what is accounting, you can think of like keeping track of all the money coming in and going out of the business. So it helps us to understand how much money the business has and how much it owes and how much it is making. So that is the purpose of accounting. Now, if we go by the definition, so what is it? It is a systematic process of recording, reporting, and analyzing the financial transactions of a business. All right. Now, what are the main purposes of accounting? First of all, to maintain a systematic record. Then, to determine the financial outcome of operations. Let's say we are producing 500 tiffin boxes per day. So, what is the outcome of it? Of whatever we are doing, what is the outcome of it every day? Okay. And then there is to ascertain the financial position of the business. Is the a particular business making a profit or loss? Is it having more equity or more debt? So what is it? Equity, debt, these concepts are how much money you have put into your business or all the shareholders, and how much is it a liability. That means how much you have borrowed, because if there is too much of debt in any business, it is a negative sign that your business may not sustain since you have taken a lot of debt. So these are the things that we study when we talk about the ratio analysis. For now we are just having a rough introduction of all these. So in the simplest terms, if I want to paint a picture, imagine you have a lemonade stand, and every time you say make a sale, and every time you sell a cup of lemonade, you write it down in a notebook. Now that's like recording your sale. Then you can also write down how much you spent on lemons, on sugar, and on cups. That is your expenditure, that is your cost. So that's recording your expenses. Now, at the end of the day, you add up all your sales and subtract all your expenses to see how much money you have made. Because that is what business is for. You want to make sure that whatever cost you have put in, you are able to recover it, and that too with the profit. That is the sense of business, right? Now, after you, so that's like summarizing your financial transactions. Accounting actually helps us to keep track of all this information so that you know if you have your lemonade stand is making profit or not, because that is the end goal of any business. All right, now to aid in rational decision making, what is it? The decisions that are made in business, that depends on the key metrics of the business. If let's say there is no proper sale, or so I won't be investing too much on my inventory. I won't be let's say in a day I'm just selling 5 glasses of lemonade. Now for these 5 glasses, I'm not going to stock up thousands of lemonades, or I'm not going to um, keep so much stock that it at the end of the day it is ruined, so it is not even utilized. And then to comply with various legal requirements, these are the things. Now, accounting standards, if I talk about in India, so what are these? So accounting standards board is there. So it was established by ICAI on 21st April 1977. You don't have to remember the dates, it's just I'm telling for a perspective. So, it is to harmonize differing accounting policies and practices. Some people used to have this. See, it is very important that everyone is following the same standards, and in order to standardize that, we have the accounting standards that we are going to talk later in this session. What are the functions to formulate according this accounting standards for mandatory implementation? Just a minute. To ensure the transparency and consistency in financial reporting. What is the process? So it determines the areas requiring standards and prioritizing them. Don't worry about this. This is just an introduction. We are going to move on to the conceptual part later on. Okay, so these are the general instructions. Now, I have a full list of accounting standards, that is the Indian Accounting Standards, AS. Every time talking particularly about our exam for which we are preparing, every time the questions comes from this area, 3 to 4 questions, 2 to 3 questions, definite questions are there from this area. And we know that they are going to ask that what is there in accounting standard 1, what is there in accounting standard 2. So in that way, so for that, in order to understand that, it is crucial for us to remember this. Now, no matter how much I explain it, at the end of the day, you will have to mug it up. In what manner you can mug it up, that I'm going to tell you after we are done with all these accounting standards. So the point about this first module is that a lot of things are here that we need to mug up, and that's something that really irritates us definitely. But and that is how it is, because accounting standard 1, so it is about, let's say, disclosure of accounting policies. So what is there in this one? In this, you will find the criteria for selecting and changing the accounting policies, along with the disclosure of significant policies. Okay. So in this slide, what I have in this PPT that I have created, what I have done, I have summed up all these accounting standards. Here you can see full list of accounting standard. Now, in accounting standard, we have the mandatory ones and the non-mandatory ones. So here you can have a look at all the accounting standards. I'll go in detail about it, but for now, just let's have a look. So this is a full list of it. That is for your convenience so that you can revise it. You have all of it in a single PPT, and I will share this PPT after this class ends. So this list contains all of these. Then there are some non-mandatory standards. So what I have done, after we are done with all these, we'll cover some MCQs. First of all, these tricks to remember it, and then we'll talk about some MCQs on the accounting standard. What kind of questions are asked? Let me tell you first, then we will move on to the next part of it. That is the um, main theoretical conceptual part. So in exam, you'll find a lot of questions that what does AS2 deal with? Now, no matter how much you have understood that, at the end of the day, you'll have to mug up that which accounting standard talks about what. So this, okay, then this is the first type. Then there would be questions, which accounting standard is related to cash flow statements? Okay, and these questions have been asked in past, so this is something that I have analyzed properly, that this is the type of question that is asked from the accounting standard, and once you find a trick to remember it, it is going to be some low hanging fruit for you. So yes, all right. So these are the accounting standard questions. I'll discuss about it after we are done with the accounting standard. So let's give it a try. Let's start from the first accounting standard and see what does it entail, and let's see if you understand it once, it is going to be easier for you to remember. Let's understand all the accounting standards, the Indian accounting standards. Okay, all right. Now for the first one, um see, it talks about the disclosure of accounting policies. So it outlines the criteria for selecting and changing accounting policies along with the disclosure of significant policies. What is it? Let's talk about each in detail. Okay, all right. Now see, the first one, see, if we talk about the whole accounting standards, there are certain components that are there. So let's break it down. First of all, recognition. So just a minute, I just have to, just a moment, just a All right, let's continue. So, for the first one, so AS1, when I talk about it, it primarily deals with the disclosure requirement for accounting policies that are adopted by any entity in preparing and presenting its financial statement. So, if I'm having a business, I would be at the end of the year, I'll be disclosing it, and for my, let's say, I have a listed company, so I'll have to be very specific about um, what is the position of my business, what is the situation of my business. So for the first one, let's say company A sells some electronic goods, and this revenue recognition policy states that the revenue from the sale of good is recognized at the point of delivery to the customer, as this is when the risk and reward of the ownership are transferred, right? Now, the company discloses this policy in its financial statement as follows, as I'm telling you. So, revenue from the sales of goods is recognized when the goods are delivered to the customer, and the significant risk and the reward of ownership are transferred. Okay, so now this policy ensures that the revenue is recognized when the company has fulfilled its obligation under the sales agreement. If I'm having a company that sells, let's say, hair bands, now it's not so that I just received an order on Amazon and I declare it as no, the ownership is transferred, and the all these things, like the process has completed. So the revenue from the sales of the goods, it is not recognized at this moment. It is recognized at the time when the goods are delivered to the customer. Okay, so whatever significant risk and the rewards of the ownership are, they are transferred. So here, I hope that you are clear with this first one, that is the disclosure of accounting policies. This is a mandatory standard that you have to outline the criteria for selecting and changing the accounting policies along with the disclosure of significant policies. It is important to understand any company's working and how it operates, and any shareholder, any stakeholder in that business needs to know about it. Okay. All right. Now let us move on to the scope of it. So where it applies, so accounting standard 1 applies to all the entities that are preparing the financial statement under the Indian accounting standard. We call it IND AS. Okay, this is given in your Macmillan book, and it is an important part of your syllabus. So accounting standard 1 is followed by any entity in preparing and presenting the financial statement. What is the objective? The objective of this AS1 is to ensure that the financial statements provide user with the relevant, reliable, and comparable information about the accounting policies that are adopted by the entity. Okay. So it is there to promote the transparency and to enable the user to understand how the financial statements are prepared and the impact of accounting policies on reported financial performance and the position of the company. Then disclosure requirement, if I talk about it, so this AS1 requires entities to disclose the significant accounting policies that are followed in preparing and presenting the financial statement. It can be when the revenue is recognized, it can be how we measure the revenue, it can be any sort of these things. Okay. So that is about this one. Then if let's say my company has changed, my company has changed any policy, any accounting policy, for that as well, I have to show it, I have to declare it. Okay. So that is about this one. Okay. Now, let us move to the AS2. Now, accounting standard 2 is valuation of inventories. So, it provides a guideline on determining the inventory cost, and it requires reporting these costs at lower of the cost or net realizable value. So, let's say I have a lot of, I'll just give you some example for this. Then we will move on to the formal definition. Let's say there is an electronics company. Okay. In order to understand AS2, we are just taking an example of electronics company. So let's say there is a company called XYZ Electronics Limited. So this company is engaged in the manufacturing and sale of the electronic device. It maintains the inventory of raw material, then work in progress. Let's say some items are there which are being manufactured. Okay, so that is what we call as the work in progress and the finished goods. So how this AS2 applies to valuing its inventory in the case of XYZ Limited, let us understand that. See, my purpose of doing this is, if you understand all these policies well, it is going to be really easy for you to remember. And there is a short question every time from the accounting policies. So once you have heard me, I'm sure that it is going to be easier for you to mug up all the that which accounting standard talks about what. Just a minute, let me just change the name of it. Okay, all right. So now, okay, so XYZ Electronics Limited is there, and it uses the weighted average cost material. Let's say you don't need to go in detail of what is that method. I'm just telling you about it. So, what is the cost of inventory? In order to determine that, the XYZ Electronics Limited, let's say it uses the weighted average cost method. Now, this method, what it does is it calculates the average cost of inventory items based on the cost of goods available for sale and the quantity of inventory units sold. Okay. And how it is doing the valuation, let us understand that. So, at the end of the recording, this reporting period, this XYZ Electronics Limited assesses the carrying amount of its inventory to ensure that they are not valued at amounts higher than their net realizable value, whatever they can realize. Let's say I have some electronics item which I am going to sell for 5,000 rupees, but I am valuing it for 10,000. No, I cannot do that. Whatever the net realizable value is there, either that or the cost of it, the actual cost might be 3,000, so I cannot I cannot take the value higher than these. Okay, so this assessment involves the comparison of cost of inventories to their estimated net realizable value. Let's say an example. So if the cost of certain finished goods exceed their estimated selling price, let's say I'm assuming that this item would be sold at 6,000, but the cost of this finished good it exceeds it. The cost that I incurred in creating it is 7,000. Okay, so considering the this completion and selling expenses, this XYZ Electronics Limited would write down the carrying amount of these inventories to their net realizable values. Okay, let's give some simpler example. Okay, because it is difficult, it is overwhelming for the first time when we are studying. So I'm giving you a simpler example. Let's say, let's consider a small ice cream stand that is operated by someone. Now, let's say her name is Lily. So Lily keeps track of her inventory using the accounting standard 2, AS2. Now, what would be the measurement basis? Lily uses the first in, first out method to determine the cost of her ice cream inventory. This means the first ice cream cone she buys are the first one sold. Okay. Now, at the end of the month, Lily assesses the cost of her remaining ice cream inventory. She checks if the cost of the ice cream cones is higher than what she expects to sell them for. Okay. If, let's say, the cost is higher than the expected selling price, she adjusts the value of her inventory to match the lower of the cost or the net realizable value, that is the selling price. Then, about disclosure, what she does is Lily mentions that she values her ice cream inventory using the first in, first out method. Whatever method she has used, she has to disclose it in the financial records. Okay. And she also has to disclose if she has made any adjustment to the value of her inventory in order to reflect the lower of the cost or the net realizable value. Then, let's say, suppose Lily realizes that some of her ice cream flavors are not selling well and are unlikely to fetch their original cost. That means, what is the original cost? Let's say I incurred 50 rupees in creating this flavor of ice cream, but I realized that this flavor is not getting sold, so it is unlikely that it is going to be sold at 50 rupee. So, in accordance with the accounting standards 2, what I would do or what Lily would do, Lily would adjust the value of these specific flavors in her inventory to reflect their reduced net realizable value. So, why is she following this AS2? To ensure that her ice cream inventory is accurately valued, proper valuation is there. Okay, preventing the it would my 300 rupees, but in it's only 300 because it is being sold at 30 rupees now. So in order to avoid this confusion, this accounting standard is there. Okay, so this helps the person to make the informed decision about the pricing and purchasing, and ultimately contributing to the success of this business. Okay, this is about the accounting standard 2. Okay, so it is about valuation of inventory. I hope that it is clearer to you now. Now let us talk about the accounting standard 3. Okay, um So first I'll explain this in simple terms, and then we'll move to the original definition of it. So when I talk about the accounting standard 3, it is about the cash flow statement. Now this question is also there, and at the end of this class we'll be discussing the questions. So I hope that you all will remember all these things, and it is going to be very easy for you if you solve some questions just after this to check whether you are able to retain what you have studied or not. All right. So this accounting standard 3, which is about the cash flow statement, it primarily deals with the preparation and presentation of cash flow statement. Acha, are you aware of what is this cash flow statement or not? Can you write down in the chat box? Are you clear about it? What is this cash flow statement? What is this cash flow statement? Can you tell me? Because if you're not clear about that, it is going to be difficult for you to understand this. So in simple terms, if you can tell me that what exactly is it, some idea about it, cash flow statement. So see, I'm just making it simple for you. Think of cash flow statement like a record of all the cash that is coming into and going out of a business. So it's like keeping track of how much money you have in your wallet and where it's coming from and going to. That is what it is. Okay. So, like the example that we have taken from the lemonade stand. So, if you sell lemonade at your stand, the money you get from selling the lemonade is the cash coming in. And let's say that if you have to buy more lemons or the cups or the sugar, that's the cash going out. So the cash flow statement helps you to see if you are making enough money to cover your expenses and if you have enough cash to keep your business running smoothly or not. Okay. So this is about the cash flow statement. If you want the formal definition of it, in that you can consider this that the cash flow statement is a financial statement that shows the inflow and the outflow of cash and the cash equivalents. If let's say account receivable is there, that I have to receive, okay, someone has taken some um, 50 glasses of lemonade but they have not paid it yet, so they are going to pay after 1 month, so that is account receivable. That is also part of it. Okay. For a specific period, it is accounted. It provides some valuable insight into how cash is generated and used by an entity, which helps the stakeholders assess the liquidity and solvency and the financial flexibility of the business. Okay. So it is like a snapshot of all the money that is coming in and going out of a business over a certain period of time. Typically, it can be a month or a quarter or a year. So it categorizes certain activities. I'll tell you about it. So why we are covering it? Because it is going to make our concepts clear. Because these terms you are going to hear a lot when we cover the later parts of the subject. In the other modules as well, we'll be using these terms. So the purpose of module A is to make you accustomed with the accounting concepts. Okay, that's why I'm going in detail about each thing. Now, let's say what are the activities that are there? So operating activities are there. First of all, there are mainly three categories of the activities. First one is the accounting activity, this operating activities. So cash flows from the primary business operations of the entities, like let's say the sales revenue or the payments to the supplier and the employees. That is the operating activities. Okay. And then there is this investing activity. So cash flows from, let's say, some purchases or sale of long-term asset. Like let's say there is a property, I have purchased a shop to sell lemonade or something like that. I have purchased some equipment. That all is there. Okay. And if we are investing in securities, that is also a part of it. And then there is this financial activity. So cash flows from the transactions with the creditors and the investors. Let's say I have taken a loan of 5 lakh to run my stall, or if I have given equity to someone, if I have issued shares, if I have repaid the debts, if I'm paying to some individual, that all comes under this. Okay, all right. So I hope that now it is clear. Now let's talk about the AS3. Since you are clear with, I hope that you're clear with what is cash flow statement. Is it clear to everyone? I'm going to look at the chat box now. Please reply me in the chat. Are you clear with what is this accounting standard? Sorry, the cash flow statement. What is the cash flow statement? Is it clear? Prajakta ji, are you trying to say something? Hello? Okay, I think she got disconnected. No problem. Okay. Now let us talk about the accounting standard 3. So, AS3 deals with the preparation and presentation of the cash flow statement, which is going to provide information about the cash inflows and the cash outflows. Okay. During any specific period. So, what is the purpose of AS3? So, AS3 exists to show how money moves in and out of a company. So, it's like a report card. It is going to reveal how much cash a company makes, spends, and where it comes from. There are three main sections. I have told you about it: operating activities, investing activities, and financial activities, like I have explained you. Then this there is a indirect method as well. So the cash flow statement usually start with the net income and adjust it for the non-cash items and change in working capital to get the net cash flow from operating activities. Why is it important? See, it is crucial because it tells the investors who are going to invest in your business whether a company can pay its bills and debts, and how it's investing its money, and how it's raising more cash. How am I purchasing the lemons to make lemonade? How am I purchasing the sugar? Am I taking debt for that? Am I making profit? Am I in loss? And all these things are clear to them. So the accounting standard 3 helps everyone understand how companies cash moves. What is the movement of cash? And it is really essential for making smart decision about investing. If let's say you are my investor, so before investing in my company, you would want to know how am I spending and how am I running my business? Am I just taking debts? Am I making any profit? How am I spending the money? And how am I earning? All these things you can get from the accounting standard 3. Okay. So this is about this one. Now let's talk about the accounting standard 4. So it is contingencies and events occurring after the balance sheet date. See, what happens? Accounting standard 4, if I simplify it for you. So it deals with how to account for the contingencies, that means the emergencies and the events that happens after the balance sheet date, but before the financial statements are authorized for issue. What all it contains, I'll tell you about it. So first of all, the contingencies. What is contingency? There are some uncertainties, like let's say there was a flood because of which my stall was impacted. Now this was not foreseen. I did not know that it is going to happen, so I was not prepared for it. It is something that has happened, and it is a contingency. Okay, so it is an uncertainty. Okay, now what happens? See, mm, the contingencies, they are the uncertainties that exist at the balance sheet date and can result in a gain or loss in future. Let's say, think about it. While at the time when COVID started, no one, let's say there was someone who used to make mask, the face mask. Now, earlier they were selling just a few pieces to the doctors, to the people who are in hospital, or we were not using it. But as soon as COVID started, the sales they jumped to a very high numbers. Now, it need not to be always a negative outcome. Contingency doesn't mean always negative. It can be an unforeseen profit as well. They became profitable and which was unexpected. So it is again, or it can be a loss as well. Okay. Depending on the occurrence or non-occurrence of certain future events, if something is there. So let's say there was some pending lawsuit and you received some lump sum amount. Okay, you have not expected it. Or let's say you lost that lawsuit and you had to pay 50 lakh rupees to the other party. Okay, so something like that. Or there was some tax dispute, or let's say some warranty claims are there. Okay, in electronics item, in other items, it can happen, no? So that is about this one. Now, about recognition and disclosure. So if a contingency is probable, that means it can happen and the amount can be reliably estimated. It should be recognized as a liability or an asset and disclosed in the financial statement. So what does this AS4 say is that if I know that I am fighting this particular case and it is possible that I may lose this case and I may have to pay 5 lakh to this other party. So if it is probable, I should disclose it in the financial statement. Okay. And if a contingency is reasonably possible but not probable, that means something can happen, but it is not certain. So it should be disclosed in the notes to the financial statement. There is a section in that notes you should disclose it. And if the contingency is remote, let's say the chances are very low for which, okay, some totally unforeseen events like COVID was there at that time, we were not expecting it. So it should not be recognized or disclosed, because before that financial year, in the financial year 20, no one would have declared in their financial statement that this can, although we all know that any natural or any kind of man-made disaster as well, natural disaster as well, it is probable, it can happen, but the contingency is remote in that case because the chances of occurrence is very low. We are not certain about it. So in that case, you need not to disclose it. That is what the accounting standard 4 talks about. So but events that are occurring after the balance sheet date, but before the financial statements are authorized for issue, are classified into two types. First is the adjusting events. So they provide some additional evidence of the condition that existed at the balance sheet date and require adjustment to the amounts recognized in the financial statement. For example, let's say settlement of a lawsuit was pending at the balance sheet date. So we have done that. Then non-adjusting events. So these are the events that provide evidence of condition that arose after the balance sheet date and do not require adjustments to the amounts recognized in the financial statement. However, material non-adjusting events should be disclosed in the notes. I've told you that although it was not something that was um, that probable, but you should disclose it in the notes to the financial statement. Let's say a major acquisition or the loss of a key customer happened after the balance sheet date. We add it in the note section. All right. So AS4 requires the entities to disclose the nature and the amount of significant contingencies and the events occurring after the balance sheet date in the notes to the financial statement. This is about this. Whatever the contingencies are there, you have to disclose it. Whatever probabilities you know of, you can disclose it. So this basically helps the users of the financial statement to understand the potential impact of these events on the entity's financial position and the performance of the entity. So in short, if I summarize it, AS4 just provide guidance on how to account for the contingencies and the events that are occurring after the balance sheet date ensuring that the transparency and the reliability in the financial reporting is there. So it helps the stakeholders, not just the shareholders, all the stakeholders assess the potential risk and uncertainties facing the entity and make informed decisions based on the accurate information. This is about this one. I hope it is clear. So we have cleared all these. Okay. I hope that you are clear with this. Now let us move on to AS5. So do you all want to take a break of 5 minutes, 5 to 10 minutes? If you want, we can take a break of 5 to 10 minutes and we can continue after that. Okay, let us all join at 4:10, 4:05 or 4:10. Vicky ji, what about it? Shall we take a break for everyone?
Yes, madam, we will take break now for 10 minutes. Uh, uh, 4 by sharp 4 o'clock 5 minutes. People has to join again.
Yes, 4:05, right?
Yeah, 4 5.
All right, all right. So let's meet at 4:05, everyone. I hope that we are clear till this point, and we'll discuss a lot more conceptual things later on. So I'll see you all. Thank you.